This is where you really see it worldwide. The 10-year yield 1.62% to 4 decimals, 1.6186. Let me say that again, 1.6186. Massive curve flattening. The 30-year bond 2.71%. I can honestly say I haven't seen the movements like this ever. Let's go to currencies. The euro 124.01. We've been often below 124 with a weaker euro. Yen, stronger yen, 78.93. The sterling finally takes it, and also euro yen goes under 98. The commodities. This is a massive move. Let me go through it completely. NYMEX 87.65, down 3.4%. Brent 103. Wow, Brent 103.16, down 3.5%. And as Pim Fox mentioned, gold on the move. Let's just sort this out. George Goncalves with us some Nomura. George, wander in here. As I said to Michael Ferroli earlier, President Trichet has that wonderful word brutal. These are brutal times in fixed income, aren't they?
And they're verging on what you mentioned before, a cathartic moment, right? We're getting to these moments where the drops are so sharp and severe that, you know, probably getting close to an end of a move, and the market's signaling to Europe that you got to get your act together.
How can pro money participate knowing that if they get an exogenous policy response, Draghi has chicken salad at lunch, or whatever, that these markets could whip back and wipe them out?
And that's exactly why the overall activity is very low, and people are sitting on the sidelines. It doesn't take much to exacerbate the kind of moves that we're seeing. So what we call in Wall Street parlance, two-way risk. Right now we're at a point where risk can be that we gap to even lower rates, or we gap back because a lot of bad news is priced in. Let's
look at a couple charts, and some of these need some exclamation, folks. Let's wander over and look at this. Suddenly a bear flattener. This is Spain 2s 10s. The 10-year yield in Spain is elevated, and the 2 years coming up just as fast. Get me over here, Victor, doing this with my hands. I learned this from Peter Fisher. Bring the hands up like this, and then let's go back to the chart, and you can see that rollover of the 2s 10s spread. I mean, this is what pros look at. They look at spreads and not individual yields.
That's right. I mean, look, right now the market's almost trading. I mean, most bond markets around the world are almost trading on price, not even on yield. It's all about...
What does that mean?
What does that mean? You're not really sensitive to what the interest coupon that you're going to receive over time.
I need to be in this paper to hide.
I need a place to put my cash.
Who buys a 2-year German yield at 0%?
Everyone in Europe that's looking for safety. I mean, the European banks that have really a scarcity of collateral. And it's really emanating out of Europe, and it's having a spillover effect into the U.S. bond market. It's not like we're rallying in sympathy with Europe, not because there's anything too materially wrong with the U.S. I mean, you had earlier the economists from J.P. Morgan, and things aren't as bad here, but we're having this kind of similar movement because of what's happening in Europe.
I saw in the papers, I'll give credit to the FT, but it may have been Bloomberg News, this idea of Moody's downgrades predicted they're looking at all the banks of Europe, and that if I have a downgraded bank, I have to put up more collateral. Do those banks have the collateral to put up?
So this is, again, why they're scrambling for very liquid paper for
those kind of decisions.
That's right. I mean, markets are fearful of there's not enough capital in the system, and they need very, very liquid securities. Nothing more liquid than the G3 nations of the world, and the Treasury market is benefiting because of these things.
Let's look at the 2s 10s in the United States. Again, folks, this is the difference in yield between a 10-year and a 2-year, and you could see the curve flattening. Now, that's clearly in Spain. I say bear flattening. It may be crisis flattening. What does the flatter yield curve, the 10-year comes down. Let's do this again. The 10-year comes down, and the 2-year really just sort of pegged there at 0.26.
So I've actually characterized it as financial refugees.
I like that banner. It's a break exclusive. Goncalves in search of financial refugees. Continue.
And so what's happening is they're not getting enough love and enough yield or movement in the 2-year Treasury. They're moving out into the 10-year part of the curve. That's what's forcing this flattening of the move. You can't move all your cash out of Europe fast enough. You can't move asset allocation into other parts of the yield curve. They're going into the 10-year, which is causing this massive flattening.
Right.
So the refugees are hiding there.
I'm proud of this chart. This will bring a tear to George's eyes. Let's bring it up. It's a litmus paper of Italy to Spain. It's just the 10-year in Italy compared to Spain. And you can see the Italy crisis at the end of the year, Monty takes over. And is it safe to say this is not about Italy? It's really all about Spain? Is that an exaggeration?
Look, the Italians and what they're trying to do over there, perhaps they're moving a little bit faster than the Spanish, and maybe the markets are cutting them a break. But if you look at them independently, they're both having very high yields, which are not sustainable. I mean, regardless of the fact that Italy and Italian spreads are, converging a little bit there, it's not a good thing given where the level of rates are.
Can I hide in corporates or in mortgage backs, or have they come down as well as a full faith in credits?
Right now there's a lot of mortgages and corporates where the all-in yield and spread are the same. So there's not much additional kind of squeezing you can do on those markets. I think we're at that point where it's hard to call the bond bubble, but when you're at the bottom of these ranges, we could have a cathartic last move.
Right.
But markets are whistling past the bond bubble graveyard, and I do believe that cooler heads will prevail, that the Europeans are not going to let this whole system come apart. It doesn't feel that way right now because they're not really stepping to the plate, but they
will.
They do, and they need to show leadership.
I want to get this in. You wrote on China. I thought the note was smart, smart, smart this week. Let's bring this up from Mr. Goncalves. China would have been a major story for the U.S. bond market, but with the future of the euro uncertain, he understates, the U.S. dollar and U.S. bonds benefited from the flight to safety. Without Europe, we would be a serious difference of relationship with China.
That's right. I mean, look, for the last 15 years, and as this euro experiment really took off, the Europeans convinced that they're going to be material on the global political scene as well as financial scene. They've convinced a lot of central banks around the world to go buy their euro bonds. And now, if there's a chance that they're not going to exist, that's why we're benefiting in the U.S. But it doesn't mean that we're much better shape than Europe is.
Right. Well, thank you so much for coming by. Was this a break from the desk today?
It was.
This is a break. George Goncalves, thank you.